So in this video, we are going to talk about financial ratios. Before we understand the financial ratios, we must understand the financial statements. So there are three statements which are prepared by the companies. The first one being the balance sheet, the second income statement, and finally the cash flow statement. And we'll understand what these statements stands for and what is the purpose of these statements. So let us first understand a balance sheet. A balance sheet gives you a picture of total assets owned by the company, what are the liabilities which company have to pay, or what are the obligations which the company has, and also how much of the money has been contributed by the owners in form of equity. The owners can be either shareholders or promoters who bring the money to the company in form of equity. So it gives you a position or a snapshot of the assets, liabilities and owner's equity on any given date. Now when you do business, you require capital, and the capital is brought by the shareholders in form of equity, or a company borrows money and take loans and they become liabilities of the company. Now company invests that money or the capital in form of assets to generate revenues for the company or to do business for the company. So all these assets, liabilities and shareholder money becomes part of the balance sheet. On any date, the balance sheet will represent the balances of all the assets, liabilities and the money brought by the equity shareholders. Now let's understand what is an income statement. The first item on the income statement is sales. That means the amount received or receivable on account of the goods and services or which the company has sold to its customers. Now the cost associated to these sales is called the cost of sales. That means what is the cost which you have incurred to carry out your sales. So cost would mean here the purchases which you made during the year plus the opening stock or the items which are there at the beginning of the year with you minus the closing stock. That means the inventory which remains with you as unsold at the end of the year. The cost of sale would be the opening stock plus purchases minus the closing stock. Now in case of a manufacturing concern, the cost of sales or cost of goods represents the cost of raw material purchased plus the cost of converting the raw material into finished goods. Now what we have discussed so far for the cost of sale is actually for a trader, but for a manufacturer the cost of sales or the cost of goods sold represents or the raw material purchased plus converting the raw material into finished goods. That is the cost of conversion, which may include the labor, the wages paid to the workers for processing the raw material, the overheads being spent by the company on running a factory or a manufacturing facility, or any other material which has been used for converting the raw material into finished goods. The sales minus the cost of sales gives you a gross profit. Now from the gross profit, you reduce all your expenses which you have incurred during the period. Now expenses can be your marketing expenses, your selling expenses, your administrative expenses, your general expenses, the expenses which you have carried out to do your business. So when you minus the other expenses from the gross profit, you get the bottom line or the net profit. Now let us understand the cash flow statement. Now it is a very important statement which is prepared by the management of the company. Now the cash flow statement tells you how much cash inflows have been there and what were the cash outflows were there during the period when you make a cash flow statement. And finally it tells you what are the changes to the cash balances through the net cash movement. Now we understand that income statement is prepared on an accrual basis. That means the sales represents either sales in cash or on credit. Similarly, your expenses also represent expenses for which you have paid the money or they are still payable. When they are payable, it will represent a liability in the balance sheet. So the net profit, which is ultimately given by the income statement, is on accrual concept. It doesn't mean that net profit has generated equal amount of cash. So a company would like to understand that how much cash they have generated during the period. Because the cash is a very important for the management, because they require cash to incur expenditure, either for buying assets or for running their businesses, for carrying out their day-to-day operations. So cash flow statement assumes a greater significance because the management would like to know how much cash has been generated, because then they can do a planning with regard to spending of the money either for their investment purposes or for carrying out smoothly their operations. So a cash flow statement helps a company to understand the cash position of the company. Now, as we'll understand that cash flow statement is broken into three kinds of cash flows. The operating cash flow, which means how much cash the company has generated from its business, its core business of by selling their goods and services. And second, the cash from investment activities. Now, a company may require to invest money in new assets for doing business because the assets needs to be replaced after they have been used. So the cash flow from investment will generally represent how much cash has been used for investment purposes in form of fixed assets, current assets, or sometimes if the company has surplus cash, it may invest into certain fixed deposits, bonds, or shares where they earn a return. So till the time the company is having extra cash which they can't use immediately, so they would like to park this money or deploy this money in various kinds of investments in form of shares or bonds or fixed deposits. So the cash from investing activity represents that. Then the third one is cash from financing. The company may need money to do business. The money generated by the business may not be enough. So it may take loans from the banks, or it may borrow money by raising through issue of debt by selling bonds to the public, or bringing new shareholders by selling them equity shares. So all that money which is received on account of all these activities are called cash from financing.